Welcome to Target the Trade. This is Fed Razak, Senior Trading Strategist here at CMTrading. And today I'm going to discuss a trade that has been unfolding for the past couple of weeks that it still has some upside potential. But before we start, make sure to smash a like button, share, subscribe, all that stuff so you help our channel grow and we're able to reach more people. So, what is this trade and what is it about? Okay, so the particular asset to trade was oil. Now, oil has several components to it. Number one, its raw price is really supply and demand. That is where it's at. Okay, that's a simple economics to it. It's supply and demand. Now, we know that OPEC sets the production to it on a quarterly basis or a time basis that they meet and they discuss how much they're going to produce, and that surely affects the price of it. However, there's several other things that affect the price of oil. Okay, now a lot of times I get a question, well, how come the price of oil is down but I'm paying more at the pump? Okay, so there's several things to include here. Okay, now understanding the commodity of oil, that it goes through a process, right? It goes through a process from the time that it's extracted from the ground, however, from the sea, from land, whatever it's extracted from, to the point that it becomes usable either to our vehicles or to buses or to trucks, whatever the end user are. Now, there are several components that it goes through, right? So if you extract it in one country and then you need to refine it in another country, it's got to be shipped on one level, and then it needs to be refined, and then it's refined, and then it needs to be reshipped to whatever other country that you're selling it to, okay, in order for it to be consumed. Now, there are several usages to oil, not just the regular oil that we consume in our vehicles, but also diesel or chemicals. Oil does put out different types of end users, even heating oil, which is a little bit different than the oil that we consume in the gas station. So there's various different types of oils out there. So I just want to make sure that you have a more understanding of just the price and what it's trading at in the markets. Now, oil is also a future contract, which means that it does expire from month to month, and you do need to reopen the trade if you're looking to trade it for more than 1 month. And it is something that is tradable because it's both an asset and it's a commodity, okay? But you have to understand the nature of it a little bit to have a full appreciation for it, okay? So let's just jump straight into the technicality and we'll discuss that trade. So this is a chart from the time that we started the coronavirus and the markets tanked. So I'm going from the end of the coronavirus. We traded about $8 a barrel, okay? We got to that level. We even got lower than that, but the markets are not going to show it to you, but it was just mayhem. The world just came to a standstill, right? And we weren't allowed to drive anywhere. We weren't allowed to travel anywhere, that's for sure. And because of that, shipping containers also were at a standstill. So this created a massive havoc to like one day, no use of oil, right? So it created this massive opportunity as well as it slowly started coming back as the market started opening up, as countries started opening up, right? And then we got to a point where we went all the way up to $138 a barrel when the war in Ukraine started, okay, between Russia and Ukraine, and that sent shockwaves and instability in the market. I believe we even got to 148 at one point. So there were several points that, throughout this journey from going from $8 to $148, there were tremendous opportunities. Now, I'm not talking about that, but I'm going to highlight this yellow line. This yellow line represents a 200-day moving average. Now, we've spoken about this before in some of the webinars where we discussed how it's used as a support line when there's retracement. And not only is it used as a retracement support line, but it's used also to gauge the market, to see how much off of it it's going to bounce. And we've seen several times that it's bounced several times. Okay, so that is one aspect of it. So I would look at a broader view to say, where were we and where are we now, okay, in relation to the markets. Okay, now I'm going to look at a daily chart. Now, this is as we've been coming in, and we've been in a very consolidated state for a long time. We've been consolidating at this area for quite some time, between about $72 and about $80, $79, not even hitting $80 for a long time. And then finally, towards the end, you see we're breaking above this yellow line. That yellow line is what we call the 200-day moving average. That was the previous support in the weekly chart. Now, when you're breaking a 200-day moving average, that is major news. How often do you break a 200-day moving average? Look historically, you won't see it so often, and that's why it's so important to take advantage of these type of trades, to trade the breakout. Once you see that it's breaking out with some volume, that's an entry position. Now we're trading now about 7 to 8 points above that, and we're slowly inching even higher. And that's really an important element, because once we break, and now we're making this double top where we're at $80 a barrel, if we continue to break out higher, we could get to $90. Thank you for joining us for Target the Trade. We'll see you here next time.